Okay, so next on deck, Justine Underhill is going to be interviewing our friend Mark Yusko and Shy Girl, Tracy Schukert. So is Justine with us, Steve?
Yes, she is. Let me promote her so she can actually share her camera. Hello, Justine.
Hello, can you hear me?
Yeah, we can hear you and we can see you.
Wonderful. I have really been enjoying the programming so far. It's been great.
Nice to meet you, Justine.
Nice to meet you.
Yeah, a little bit about Justine. She's an award-winning documentarian and news journalist, and she was focused on finance and technology. Her docuseries with Real Vision, who we are familiar with, Discoveries, which uncovers the hidden side of technology, finance, and science, was recognized for excellence by the Telly Awards. And she previously worked at Yahoo Finance as a host and on-air reporter, covering the Fed, energy markets, and breaking news. And it's a pleasure to have you here to interview Mark and Tracy. And it's a skill to be a good host and anchor too, isn't it, Justine?
Well, you're doing a fantastic job so far.
Oh, well, you have to ask the questions that your listeners and viewers might want to ask themselves.
Mm-hmm. Right, exactly.
So I look forward to watching you work and the interviews.
Dale, I've had the pleasure of having Justine interview me once.
Yes.
So
at Real Vision.
Yeah. So I'm really happy we have her with us.
Oh, and she remembers it, unlike me, Steve from FX Street, when I didn't remember. Oh, okay. Well, take it away, Justine.
Sure. Well, I am super excited to talk to Mark Yusko, not for the first time. I've interviewed him before, actually, at Real Vision. Mark Yusko, in case you don't know, is the founder and CIO of Morgan Creek Capital Management. He's also the managing partner of Morgan Creek Digital Assets. So it'll be interesting to get his take on Bitcoin, especially after what we heard from Danielle DiMartino Booth on that. He was also previously the CIO and founder of UNC Management Company, which is the endowment investment firm for UNC Chapel Hill. So it'll be interesting also to get his take from an endowment investing perspective on what's going on in the markets. So with that, Mark, welcome. Great to see you.
Mark, no sound.
Okay, now I'm unmuted.
Yeah.
Great to see you, Justine. And I'm really glad you didn't bring up the fact of how you smashed me and Connect last time we were together, because I kind of wanted a rematch today, but I don't think losing 3 out of 3 would be good for my ego.
Oh man, I've my skills in Connect 4 have definitely dropped. I practiced for that interview.
So fun.
Welcome to the summit, Mark.
Welcome, Mark. I just want to say hi,
Steve.
Before we leave you at it. I'm really glad to have you again, and I'm really looking forward both for the interview and tomorrow's debate.
You know how I hate to debate, so I think tomorrow's not going to be any fun at all, right?
I actually think it's going to be great for the viewers, and I have more than enough confidence that you're going to be great.
That's going to be great. It's going to be great.
So enjoy.
Thank you.
Well, I'm looking forward to that too. We won't go too much into topics that you might be debating tomorrow, but there are things that we do have to discuss. I heard that you went on a trip across the country.
Yes.
And this cross-country trip allowed you to not just see economic pain firsthand, but not just see the data and the numbers that we've been reading about, but actually experience it.
There's this great line about traveling, right? And it enables you to separate reality from narrative. Mm-hmm. And, you can hear or listen to all the people talking about, oh, it's the greatest economy ever, or, there's a recovery going on. Look, the short version of a long story is my wife and son and I set out on this cross-country journey, one to see my father-in-law's 84th birthday in Tulsa, and then to go hang out with my eldest daughter who was having a baby, which she did. So now we have 2 grandkids. And
congrats.
Thank you. She's in Santa Monica, California. So we drove all the way across country and then all the way back, 14 states over 6 weeks. And the short conclusion is there is no recovery on Main Street. I saw more pain and suffering in the 6 weeks than I've seen in 20 years. Just punctuated by Santa Fe, New Mexico, 1 out of every 3 businesses boarded up, no visitors. The shopkeepers we could find to talk to were shutting down at the end of the month. The hotel we were at, which had been full to the brim the last 2 times I was there, 3 cars. It's bad out there. And all this narrative and focus on the stock market making new highs, at least it was making new highs until recently, I think is kind of crazy.
Yeah. How do you actually reconcile that, the economic pain that we are feeling versus, I mean, we're still at levels, S&P is at levels above where it was a year ago.
Yeah, look, it's all part of the plan. And it's something called money illusion. So there's this illusion that stocks are rising, but that's because everybody denominates them in US dollars. If you denominate them in real money, right, gold, they're down 44% over the last 2 years. If you denominate it in real money, Bitcoin, they're down 80-something%. So stores of value are rising. The Fed is committed to destroying the currency. That's the only way out, right? Once a government gets fully over indebted, the only way out is to devalue your currency. And the rich get really rich on paper. They feel rich. But what happens ultimately is that divide grows to such levels. Historically, there's uprisings. I'm not saying there's going to be an uprising in the US, although, man, I'll tell you, some of the stuff we saw, it was getting close. It's getting close.
And your trip across the US pretty much went through southern states, is that correct?
Well, we went through the middle first. So we went North Carolina, Virginia, Tennessee, Arkansas, Oklahoma, top of Texas, New Mexico, Arizona, California, then back California, Arizona, into New Mexico, southern part of Texas, into Louisiana, Alabama, Mississippi, Georgia, South Carolina. So we made pretty much a triangle. And it was interesting, mostly red states, a couple blue states, New Mexico, California. But here's the thing. They used to be really red. Like 4 years ago when I traveled to Alabama, every yard had a Trump sign in it. This time, not so much. So I think it's going to be a very interesting election. I actually think it's going to be very interesting and unexpected for people. But there's, like I said, there's just a big sea change going on Main Street. And to your question, to answer your question, why does it exist? Well, look, it's the mission of the Fed since 1913 to create income and wealth inequality, right? That's their mission. And you're saying, oh, that's ridiculous. No, that's their mission. Their mission is to make the rich, particularly the bankers, really rich, and to steal from the poor in the form, and the middle class, in the form of inflation. I'll give you one inflation story that was just so scary. So we go to the Grand Canyon. And by the way, I can't believe it took me 57 years to go to the Grand Canyon. I'm an idiot. I should have gone there long before. Most amazing thing I've seen. And we get there, 20% occupancy. The lodge we were staying at, 2 cars, no one there, no crowds, no nothing. And I go into town to try to get some internet service because there's no internet at the Grand Canyon, which was weird. It's kind of weird to be in a place where there's no internet and no phone service.
It's good in a way, though, I think.
It is good. No, it was good, except it's a little freaky when you're trying to keep tabs on parents and is the baby coming. But I went to a McDonald's to try to surf some Wi-Fi and ordered breakfast for my 9-year-old and I. Normally in Chapel Hill, costs us about $12. 2 big breakfasts, coffee, etc. The guy says $28. I'm like, what do you mean $28? He says, well, yeah, we don't have any volume because no one's coming to the canyon, so we raised prices. He said, no, this is McDonald's. It's like national prices. No, we're a franchisee. We're going to raise prices. I said, that's a really bad plan. Think about this. Think about being a park ranger who's been furloughed, doesn't have a lot of money because he can't work or she can't work, and now you go to McDonald's because you think it's cheap, and they tripled the prices. That's bad. Yeah. And that's what will cause unrest.
Wow. And that, I mean, getting that sort of on the ground experience, it almost reminds me of in The Big Short, when there was such a I mean, at least some of the traders, and there was such a disconnect between, you know, what was actually going on in, let's say, Florida versus what was being reported on the books. And so it almost seems in this way, like what your experience was completely disconnected from what's being reported out there.
Look,
or at least what the stock market.
There's such a disconnect. I mean, the disconnection is so extreme. And I talked about this in, we do these weekly webinars, and I talked about this last week, that last Wednesday, so a week ago Wednesday, to me was the peak of the market, right? The peak of tech bubble 2, and tech wreck 2 has started. It was the IPO of Snowflake. Now look, full disclosure, my son works there, so I'm really, really happy about how crazy it was. But the valuation of Snowflake at 227 times sales, not 227 times revenue or earnings, 227 times sales, sets a new record for stupidity. And the people that bought that stock, because Warren Buffett said he was buying the IPO, are going to lose a lot of money, like a lot of money. And I think just like Blackstone in 2007 was the top of the financial crisis, just like Glencore in 2011 was the top of the commodity boom. And you can go back to 2000, a bunch of crazy like pets.com IPOs. This was the top. And I think the pain is just getting started. So that disconnect, I think, is going to start to shrink. But, you know, we'll see. Do you see that for all tech companies, that there is going to be a downturn, or is it so across the board? Google, Facebook, Amazon, everything. Here's the problem. The market today, the stock market, is no longer a market of companies. It's a market of little tickers, little 4-symbol tickers that they've totally disconnected from the underlying company. And it's been popularized by, you know, the day trading guys who reach into Scrabble bag and pull out 4 letters and buy that ticker as if it's some gambling game. That's just like it was in 2000 when we had the day trading boom the first time. And when people buy things just because they're going up, or buy things just because they're hot, that's when the real pain is going to start. So you have companies selling 20, 30, 50. Zoom, we're using right now, sells at over 100 times revenues. There's no math on the planet, right? There's no interest rate low enough. There's no growth rate high enough where you can put pay $100 for $1 of revenue, which then has pennies of profit, and make a good return. So it works for a while, but once it starts to crash, which I believe it has, the ugliness is profound.
Do you see a dynamic where, let's say, there is general pain in other parts of the world, and so that leads to there is no other alternative to investing in the U.S. market, and so it's suddenly you have a flood of money almost no matter what?
Look, it's a great point, and there is pain everywhere, right? The idiocy of administrations, not just in the U.S., but a lot of administrations other than China, who's actually playing the game flawlessly, is really crazy. And global trade is collapsing. That's usually a bad sign. Not usually, it is a bad sign. And it feels very much like the 1930s in that respect. The last time we saw this kind of just bad global policies and a focus on nationalism and populism instead of globalization. And so I do think that there is this belief, and it is a belief, I don't think it's actually truth, but I think it's a belief that Tina, you know, there is no alternative. You should just buy US stocks because they're the best. Well, again, that works as long as it's working. But at some point, someone will say, this doesn't make sense. And then that cash will flow to stores of value, which it already has, right? Gold is outperforming stocks this year. Gold's up 20%, stocks are not, right? They're basic stocks. The S&P is basically flat. NASDAQ's up a little bit, but gold's ahead. Long bonds are outperforming stocks again, just like they did the year before. Bitcoin outperforming stocks, like not close. Bitcoin's the best performing asset again, just like it was last year, just like it has been the last 10 years. And it's because we're destroying the value of the currency everywhere. In the US, in Japan, in Europe, in Brazil, in Argentina, everyone is devaluing their currency, and it's a race to the bottom. And all that really does is inflate scarce assets. So low, high quality real estate, diamonds, collectible Porsches, anything that's scarce is going up. And that gives you this illusion of prosperity. But the reality underneath is what I witnessed on this road trip. The homelessness in America, off the charts. Nashville, Tennessee, supposed to be a boom town, tent cities everywhere. Austin, Texas, supposed to be a boom town, tent cities everywhere. We are back to Hooverville. We are definitely back to Hooverville.
I saw some of the photos that you posted, and they were actually quite stark.
And it's crazy to think that I could take those pictures just walking down the street like it was no big deal. And it's everywhere. It's everywhere.
Now, you mentioned gold, and you have your own FANG gold stocks.
Yes.
Could you talk us through, and I have the list here if you don't happen to remember what the FAAANG is.
Yeah, so there's F, 3 A's, an N and a G. Mm-hmm. And to me, the new FANG. So here's an interesting stat, right? From the bottom of the crisis, FANG, the ticker symbol, which is Diamondback Energy, has actually outperformed FANG, Facebook, Amazon, Netflix, Google. And everybody's, that's impossible. Those things were up a lot. Well, energy got so cheap that it was actually up more. And Tracy will have some thoughts on that for sure. But FANG, the new FANG, which is Franco-Nevada, Anglo Eagle Mines, Anglo Ashanti Gold, Gold Corp, Newmont Mining, and Barrick Gold. So FAAANG, those 6 stocks are up twice as much as the market. And I think they're going to continue to go up more than the market. And so I think you should be shorting FANG like the tech ones, and you should be buying the new FANG.
Yeah. Now, for these, because a lot of these gold miners, I mean, do you see there being a huge amount of risk to getting into that rather than just getting into?
No, not at all. In fact, just the opposite.
Okay.
These companies actually mint, pun intended, money. They are making more money. They made more money in second quarter than they ever have in their history. Why? Because their output, right, gold, silver, et cetera, the things that they sell are going up. The price is going up. But the things that they need as inputs, electricity, oil, are all going down. And so it's a beautiful thing. Your margins are expanding. Snowflake has $260 million of revenue, and they lost $350 million. And yet they were valued at $96 billion for a few seconds. Absolute insanity, right? How can you lose $350 million on revenues of $250 million? I still haven't figured out how you do that. I mean, it's pretty hard.
Yeah. So then going into gold, I mean, also you have your long short fund that's been doing quite well this year. Could you talk a little bit about what's the long part and then the short part of that fund?
Yeah, so it's an important thing. So we have this hybrid long short fund, and it allocates some of the money to external managers, some great hedge funds in tech and healthcare and value. I have a great manager in Australia that everybody knows that they look for both longs and shorts. Then we supersize on a direct basis the best ideas both on the long and the short side. So right now we are shifting from the kind of FANG overweight, which we have been in earlier this year, to more value. So we're shifting to value, and that's been painful. We've been early. That's the euphemism for wrong. So far that hasn't worked out that well, but so we're long, some of the materials companies, some of the energy companies, and energy's done nicely, but it hasn't done quite as well as we think it should. We still own a little bit of tech, but we own digital transformation companies. So we own companies that are on the edge of this transition from electronic to the digital world, not necessarily just things that support Bitcoin and crypto, but things that support cloud or, the Amazon roadkill, where basically people aren't going to shop, physically, they're going to shop virtually. So there's lots of things. And what COVID did is it pushed forward about 3 years of this digital transformation. In fact, on my webinar yesterday, I had a cartoon of this group sitting in a boardroom on the top floor of a building saying, digital transformation is still years away. We don't need to change it all. And outside there's a giant wrecking ball labeled COVID about to hit their building. And that's what's happened, right? This work from anywhere, right? I spent 6 weeks on the road, didn't miss a beat. I worked from hotel rooms. I worked from homes. I actually gave my webinar 2 weeks ago from the backseat of a car on the way to Austin, Texas, while my wife drove. So you really can work from anywhere. And I'm actually the biggest beneficiary because my daughter and son-in-law are now going to move to North Carolina from LA because their company has gone totally virtual. So I think it's so that's part of the long side. On the short side, we are short some of the most egregiously overvalued tech companies. We're also short.
Like which companies?
Truth be told, we still are short a little teeny tiny bit of Tesla, although not as much as we once were. But I think that one's going to go down a lot at some point. But that's a little position. But a lot of the cloud companies are it's kind of a basket of cloud companies. I don't want to pick on anyone in particular. We still believe in some of the Amazon roadkill. So we still do own some Amazon, even though I think it's wildly overvalued. But it's because we're short against it, the brick and mortar retailers, which have been going down more. So even though I don't think Amazon will go up a lot from here, I think the other things will go down more. We are short kind of traditional media. We think that, business is a dying business. We're short some of the traditional, again, brick and mortar stores beyond just, retail and apparel, things like grocery stores and things like that. So
interesting. But grocery stores, wouldn't you say, have done somewhat well during the pandemic?
They certainly have, and we think that's an ephemeral thing, right? I think people swapped restaurant spending for grocery spending, but it wasn't big enough, we don't think, to justify the move up. So, and I think the biggest thing for us right now on the short side is this migration back to fair value. I think once it begins, it becomes very durable and it's not going to be a quick, sharp down. In fact, Bob Farrell talks about this. Every bear market, he was a famous Merrill Lynch strategist. Every bear market has a sharp down, that was March, a reflexive rebound where the people are like, oh, no, it's all going to go back to normal, and then a protracted fundamental downturn. And I think that's where we are today. And again, if you look back to the 1930s, in September 29, we started down. We went down through November. Then from November till May of 30, we went up 48% from bottom to trough. Then the real downdraft started. So the crash really wasn't 29 alone. It was really 30 and 31 that caused the real pain. And I think that's where we're headed in the markets here.
And that pain lasted for a year, more than a year, actually a year and a half, 2 years.
Yeah, about a year and a half. And then the real pain, Justine, to that point, was the idiotic moves by the government to do Smoot-Hawley, right? Trade barriers, to try to isolate America, to try to save American jobs. They literally rounded up. They had the Mexican Repatriation Act. Imagine this. They went around, physically grabbed people of Mexican descent, even if they're American citizens, and physically moved them back to Mexico to try to save jobs. Sounds really familiar to the current environment. And the craziness of that period turned what was a garden variety recession into the Great Depression. And I think we're in a garden variety recession enhanced by COVID, but COVID was a shock like 9/11. It won't last forever, but the responses to that shock, if they're really bad, which they have been so far, like lockdowns are really not very well advised. If those responses continue to be bad and we do things like throw up trade barriers and we, go inward instead of outward, I think it could turn this garden variety recession into something much worse. And as I said, what I saw on the road says we're on the verge of that already.
Would you say that the 29 depression is the most analogous depression recession situation to today? It's more than let's say 2008 or any 1987. I don't know, we can keep going back to other ones.
It's a fantastic, very insightful question. Everyone likes to compare it to the global financial crisis. This is not the global financial crisis. The global financial crisis was an unwinding of excess leverage in the financial system. The financial system isn't as levered today. The banks aren't as levered. Hedge funds aren't as levered. I mean, some hedge funds are, but most hedge funds aren't as levered. Financial institutions, there's not the crazy lending that was going on where if you could fog a mirror, actually, if you didn't even have to fog a mirror, you could get a loan. They were just making stuff up, the liar loans. So that's not the problem. And it's even not like 2000 is a little bit analogous because the valuation of tech stocks is very similar and the debt levels are very similar. But the reason this is more like 29-30 is in 29, we had a 10-year crazy period, right? We had the roaring 20s where everybody literally lost their mind. They levered up, they speculated, they became day traders, they left their jobs to trade stocks. And the government did everything they could to try to perpetuate this myth of prosperity. And so they increased leverage and we got to massive government debt levels. And then you had the aha moment, right? The crash where everybody said, uh-oh, and you got big margin calls. And then you started to have the unwind. And again, then the government made the bad decisions to constrain liquidity. So the one thing the Fed has done right this time, even though I don't like it, is they have kept liquidity ample, which has increased the size and scope of the bubble and put off the pain. But like anything where you do that, if you put off going to the dentist, when you eventually go, you get the root canal. Or if you put off going to the doctor, when you finally get that heart attack, it's really bad. So you should try to take care of things early. And this obsession, I call it the participation trophy world that we live in, this obsession with not letting failure happen is crazy. I mean, think about this. You got a kid, they come home from school, they have 4 A's and a D. What does the average American parent do? Oh my gosh, we got to get you a tutor. You got to spend all your time on this D. No, drop the class with the D and focus on the thing they're good at, because you don't have to be good at everything. And we have companies out there, 40% of companies can't cover their debt service with their EBITDA. Forget paying back the debt. They could never pay back the debt. They can't even pay the debt service, the interest. So we should let those companies fail, but no one wants to let companies fail because those are voters and everybody thinks they got to save everything. So, we're going to keep handing money out to people. UBI, maybe one of the dumbest things ever created. It's just communism with a nice label. And making people the same and taking away incentive to create and innovate is just a recipe for disaster. Again, it's what we did in the 30s. I hope we don't do it again.
There was a massive deleveraging to some extent in 2008. Do you see that happening in the next year, 2 years, 3 years? Do you see some of these cycles coming to fruition? Again,
really insightful question. The leverage in the household is really high, right? Households, they're up to their eyeballs in debt. It's the only way they can survive. Governments up to their eyeballs in debt. Corporations up to their eyeballs in debt. Highest levels of corporate leverage. The problem is, as Ray Dalio at Bridgewater talks about, what you want is a beautiful deleveraging, right? An orderly deleveraging. The problem is deleveragings usually don't happen that way. They usually happen sharply, like they did in 08 and 09, like they did in 02. And 02 to me is the better analogy than 08, 09. This is a corporate debt problem and an individual debt problem. And just like WorldCom and Enron in 2002, I think Nikola is the first shot across the bow. The fact that this miracle company that everybody loved and was going to be the next Tesla might be a fraud, and all the people that lent them money are not going to get their money back. If there are more frauds, like if Tesla turns out to be a fraud or if somebody else turns out to be a fraud, then it could get ugly in a hurry and people will ask for their money back. And there's that famous picture, I don't know if you've seen it, of the Knickerbocker bank run in 1907, where JP Morgan leaked a rumor about his competitor, the Knickerbocker Trust, because the Knickerbocker Trust was taking all the business from JP Morgan's beloved JP Morgan. And he leaked a rumor that they didn't have enough money to pay depositors. So it triggered a bank run. And of course, he was there to pick up the pieces like, Mr. Potter in It's a Wonderful Life, based on a true story. And that's how we got the Fed, right? Because JP Morgan's best friend was John D. Rockefeller, whose father-in-law was Amory Aldrich, who then created the Aldrich Plan, saying, look, we need a central bank to save us from these crazy trusts, which we bankrupted, by the way. And so it all comes together. And then they created the silly thing on Jekyll Island. You can't make this up. And so a friend of mine was just saying, Mark, next year we need to have a get-together in Jekyll Island. I'm like, oh, that would be so awesome. So we may actually go there and do an event.
You should do like a podcast or something, host some sort of event from there.
Oh, we want to do like a live get-together macro event. Get everybody that's online now. We'll all come physically to Jekyll Island and have a big party to celebrate the demise of the Fed. So.
Oh my gosh. Well, actually, going on this historic trend, we do have a question here, which I think is interesting. We have this person asking if, there were fewer that could take profit from a crash in 1929 because you didn't have the extensive shorting market that you do now.
Yeah.
So is it easier to actually profit in some sort of downturn today than, let's say, in 1929?
Wow, fantastic question. And it's the reason we love long short equity. I mean, if you go back in time, it's 100% true that in the 20s and 30s, again in the 60s, it was very difficult to really profit from these big downdrafts on this 60-year cycle. And so we're back to that kind of 60-year cycle with a downtrend likely. And in fact, it's pretty amazing. I was in West Texas, in the middle of nowhere, right near where W.D. Gann was born. And he's the guy that wrote this book in 1901 that laid out every market peak and trough over the next 150 years. And he predicted that 2020 would be a bad year, just like he predicted 29 would be a crash, just like he predicted 73 and 2000 and 2008. So pretty good predictor, all based on this Benner cycle from 1864 from Samuel Benner. Long story short is we knew the pain was coming and we couldn't fix it in the past, but starting really in kind of 2000-ish, if you look at the 2001, 2002 period, the markets were down 40%, hedge funds were up 10%. In 2008, 2009, everybody said, oh, hedge funds don't work anymore, shorting doesn't work anymore because the market was down 45 and hedge funds were down 20. Well, that's because it was a liquidation and people got liquidated and they were forced to sell what they had to sell rather than what they wanted to sell. I think this time, because there's not as much leverage in the system, what we've seen and why our fund's up, over 20% this year, the short side is really kicking in. And ExxonMobil is one of my favorite poster children, right? We got short this thing a long time ago. And it's not that we think it's going to demise quickly. It's just it's in a horrible place. It has two different businesses, refining and exploration and production. So no matter which way oil prices go, they make a little and they lose a little. So they're basically just a conglomerate. But the problem is conglomerates with high expense ratios basically are going to erode in value. And that's exactly what that stock's done. And Julian Robertson has this great line about shorting. A short doesn't have to go down to be great, as long as it finances a better long. And so why the long short strategy is so good is I can short something like Exxon. I don't even need it to go away. I just need it to not go up so that then I can buy one of these digital disruptors on the long side and make money that way.
Interesting. Now, we have another question here from AG who says, does Mark think that we might go into a stagflation period? Do you think that would be possible?
Yeah, I don't. And look, I'm going against one of the people I admire most in this business, Kirill Sokoloff. Kirill Sokoloff runs 13D Research, one of the smartest people I've ever met. Been fortunate to have him as a friend and mentor for many years. I literally stumbled across a book that he co-authored with Gary Schilling back in the 70s that no one read. And even I didn't read the whole thing, but I read the cover. And the cover was "Inflation's Ending, Are You Ready?" Written in 1981. So no one thought inflation could ever, happen. And so inflation did happen, obviously. And no one thought inflation could stop because we just had the big inflation in the 70s. And inflation has stopped, and it's gone down for 30 plus years. And so now he's on the side of saying that inflation is coming back, and that's why he loves gold and gold miners. I like gold and gold miners for a different reason. I like them for deflation. I think we're stuck in a deflationary death spiral. So I see no inflation other than that McDonald's I was talking about, which that's real. That's real. Yeah. But that is offset by the deflation in everything else. Real estate prices are going to collapse, particularly urban center real estate, as people flee, right? They're going to move to a place like North Carolina where you can get a lot more house and you can work from there. So real estate prices are going to collapse. I think the problem we have is people believe inflation is always and everywhere a monetary phenomenon, Milton Friedman. It's not. It's a demographic phenomenon. You have inflation when you have lots of young people. When you have lots of 25 to 45-year-old people, you have lots of inflation because 25 to 45-year-old people are not very productive. Doesn't mean they're not perfectly nice people. They're just not productive in the way we measure productivity because they're still learning. So companies have to borrow in the form of higher prices to train their young workers. So if you look at every country around the world that has high inflation, India, for example, they have lots of 25 to 45-year-olds. On the flip side, 65 to 85-year-olds are not very productive either. Again, perfectly nice people, but they're not productive. All the productivity in an economy happens with 45 to 65-year-olds. So every baby bust country, Europe, Japan, US, is all on the far end of this graying demographic, and that's going to put huge deflationary forces. So I call it the killer Ds. You have bad demographics, 10,000 people turn 65 every day. You have too much debt. Debt is highly deflationary because it crowds out spending and wealth creation and innovation, particularly government debt, the worst possible kind, which our current administration thinks is a good thing. So they're creating lots of it, which is bad for the future. Look up Lacey Hunt if you're curious about that. So demographics plus debt equals deflation. So I see no inflation. In fact, here's a prediction. Every interest rate in the world soon, probably sooner than anyone believes, will be negative. Forget high rates. We're going to have negative interest rates everywhere in the planet.
Even the US?
Within 5 years, in the US. In the US, everywhere.
That
everywhere.
A lot of things are like based on US interest rates, whether
Yes,
it's like Black-Scholes formulas, all sorts of other things. Don't you think that would cause like huge ripple effects?
Of course. Look at the Japanese banks. 26 years, they've gone down. Look at European banks making new lows every day because they have negative interest rates. We will have negative interest rates. Look, we're at 0.65 on the 10-year. 0.65. A year ago, we were over 2%. And everybody thought we were going to 5. Look, the bond kings, Gunlock and a bunch of others said we're going to 5% rates. We're at 0.65. We will have negative rates because think about it. If 40% of companies today can't pay interest with sub 1% rates, how would they pay interest with 2% rates or 3% rates or 4% rates? They can't. So interest rates will continue to go down. And it's not until the echo boom, right, the kids of the baby boomers turn 45, okay, then we can get productivity enhancement again. We're still about 15, 16 years away from that. So it's not looking good.
Yeah. Well, we have a whole bunch of questions coming in. I don't think I'm going to be able to get to all of them.
Well, they can email me. They can send them on my Twitter. They can DM me. I love questions, but...
Great. Okay, well, we'll try to cover some of them and maybe try to loop them all together, bunch them together. So we have one, which is, and I want to get your take on China with this as well. So American tech companies are getting bigger and bigger outside of the US. So don't you think that phenomenon might continue? And then maybe you compare that with what you see Chinese or the future for China-specific tech companies and where that's going like 10
Yeah, look, again, really great question. The problem right now is because of fear and because of lack of understanding, again, by our administration. When I say administration, I don't mean the president. I mean the president and the Senate and the Congress, that whole group of mostly white guys. There are some women too, but mostly white guys. They live in the wrong world. They live in this, inward focused, nationalistic, populistic world. And they're fighting a fight that we can't win. And it goes around tech. So tech evolves over time, and we're on the cusp of this technological evolution into the internet of everything, where everything in the world is connected, right? So we went from mainframe computers in the 50s to the microchip and small computers to personal computers in 82 to the internet in 96 to the mobile net in 2010. And now in 2024, we're going to have this internet of value all around blockchain technology, and everything in the world will be connected. And so 10 years ago, you kind of had to choose what technology did you want to be expert in. And America, unfortunately, chose social media. So we're awesome at Facebook and Instagram. We're awesome. China chose AI and 5G. So they are killing it in those areas, particularly 5G. And 5G is the key, because 5G is what allows connectivity everywhere. Think about a driverless car. Would you get in a driverless car if it had the same reliability as your cell phone that drops a call every third mile? No, you'd never, because you need 100% all-time connectivity, because if the car disconnects from the network, you could crash and die. So you need 5G. It's really, really important. And you need algorithms that can learn in a true AI way. So China's leading. And so the US is saying, China's bad, China's evil. We're going to spread rumors about them that aren't true. We're going to say they're stealing from us. No, we're stealing from them because they have better technology. And yes, the US companies are more global, but they're reaching a saturation point. And now it's time to flip into this new era of 5G and AI. But what's happening instead is we're creating two camps. And unfortunately, what I think is going to happen is we're going to have two internets, which is the worst possible outcome. We're going to have a Chinese-centric internet all over Southeast Asia, because they have been brilliant in doing the Belt and Road Initiative and going into Pakistan and India and Southeast Asia and Indonesia, where there are billions of people now all going to be interconnected, like the recreation of the Silk Road. And America, little part of South America and Western Europe are going to be one area. That's a couple billion people. Theirs is going to be bigger, better data, more, faster, better technology. And we're playing catch up. And rather than collaborate, imagine this. Imagine if China said tomorrow that Apple can't sell phones in China. That would hurt Apple a lot more than we could ever hurt them. And what we're missing, and I'll end here because it's a long answer, but you know the story of Singapore, right? Singapore was under attack from the Japanese, and Singapore is an isthmus, and they had these big giant guns, and they knew that Japan was going to come in by boat, and they'd blow their boats out of the water. Well, Japan was like, well, we're not going to get blown out of the water. We'll just park the boat over here, and we'll march over these high mountains and come around and surprise them from the back. So the guns were pointed the wrong way. So Japan took over Singapore. Now, the same thing's happening in the US. We're fighting the wrong war. We're fighting as if it's all about made in China, about losing jobs to China. 20 years ago, my friend, his daughter came up to him and said, Daddy, I thought you said Santa Claus brings the presents. Well, they do, honey. Why? Well, why do they all say made in China? Okay. So 20 years ago, 10 years ago, that's what it was all about. We outsourced our jobs and our pollution to China. Okay. And we got back cheap stuff. So our quality of life went up. We all had gadgets and gizmos, and they were really cheap, and it was awesome. Well, now we're still thinking that it's about made in China. Now they've gone from a manufacturing powerhouse like we were post-World War II, and for the next 50 years, we became a consumer powerhouse. They are going to go from a manufacturing powerhouse to the biggest consumptive force the world has ever seen. So we should be focused on making stuff to sell to them, and we should want to be friends, not enemies. It's not hard.
It's definitely a major shifting dynamic that we've had. Mark, I want to thank you so much. We're at our 45-minute mark.
Yeah, I know. I talk too much. I give long answers. I always say I don't do short, so I apologize. But
no, that was great.
Thank
you.
I love talking with you because you have the best questions. You do your homework, and I can talk to you all day.
Oh,
People
yeah.
are asking. People are
thank
asking
you, Mark.
where they can find you, and on the Trader Summit website, you can find everything. I mean, his social media, his website, and Mark is always available on Twitter as well. I can tell you from experience, if you want to throw him a message, he's going to answer.
Yeah,
And
the
Mark,
best way to get me, actually, truly, I'll tell you how great it is and how I love Twitter as a tool. So, I've met the greatest people. I've met people in Greece. I've met with the presidents of Greek banks because of Twitter. But today, just to make it more personal, so my son and I have been playing Pokemon Go. And there's this thing in Pokemon Go where you have to coordinate, but there's no direct messaging inside Pokemon Go. So a woman direct messaged me on Twitter and said, hey, we need to coordinate this thing. And I'm like, perfect. So life is good on direct message on Twitter. So at Mark Yusko, if you care.
Thank you, Mark.
Thank you very
And,
much.
guys.
and Mark, I'm from Chicago. I know snowflakes. I've seen them freeze and I've seen them melt.
Look, just full disclosure. No, Dale, that is so good. Here's the thing. No one could be happier for Snowflake. It's an amazing company. They're changing the world. What they do is awesome. I'm so glad my son works there. I'm so proud of the company. And I don't mean to cast aspersions on them. They're a fantastic company. The thing that's crazy is what people are willing to pay for that
Valuations.
stock.
Valuations are just
It
nuts.
has nothing to do with the company. The company
I know.
is
I had
amazing.
to shovel
The
it,
people are
and I didn't
amazing.
get paid much. So anyway,
Yeah.
Mark,
Shoveling snow in Chicago, that's bad for your health. All right, guys.
Nice
be
seeing
good.
you.
Thank you, Mark. Looking forward to seeing you tomorrow.
Yeah.
Great job, Justine.
Can't wait.
Great,
Bye, guys.
thank you.